Hello and welcome to Switzer Super TV. I'm Peter Switzer. Thanks for joining us. This is my colleague Paul Rickard. Hi Paul.
Hi Peter.
Let's talk about the difference between listed investment companies or LICs and exchange traded funds or ETFs.
Look, the main difference, Peter, is a listed investment company is actively managed, whereas an exchange traded fund is passively managed. That is, it's designed to actually track an index.
Yeah, my favourite ETF tracks the S&P ASX 200 index. They buy all the shares. I'm driving home. I hear the market's up 2%. I figure I make 2% minus the fee.
One of the great things about an ETF is you know exactly what you're going to get. There are actually more than 90 ETFs listed on the ASX, and they cover things such as individual sectors. They're ones exposed to the broad market. They cover commodities like gold and silver and other things. And what you know about them is you'll get an index return less a fraction, and you can be pretty confident about that. On the screen in front of you we have the three major broad-based ETFs. iShares IOZ, the SPDR or SPDR STW, which follows or tracks the S&P ASX 200, and Vanguard's VAS, which tracks the S&P ASX 300, together with the performance of the actual S&P ASX 200. And Peter, the key takeout on that is they'll basically give you the index return less a fraction.
Yes, and that's a passive way. The active way is involving LICs.
Yeah, LICs, the manager's actually, making a decision about how to invest. And again, we've got a whole nature of LICs. We have some that just invest in the smaller companies, but there are also some broad-based LICs. And on the screen in front of you, we have three of the broad-based listed investment companies: Australian Foundation, or ASX code AFI, Argo, stock code ARG, and Milton Corporation. And in fact, Peter, Milton Corporation's been around since 1958. The key point to note on these is that by and large sort of matched the index, in fact outperformed in some time periods. So overall they've done pretty well. Okay,
talk about the net tangible asset or net asset value. That's important.
Well, it's a really important concept with a listed investment company to understand what we mean by NTA, or net tangible assets. The best example is to take a sort of a trivial example. Let's assume you set up a company to invest in three other companies, and it purchased one of share A at $4, one of share B at $5, and one of share C at $6. That would give a total value of $15. So if you are now buying a share in that listed investment company, its net tangible asset value would be $15. Because it trades independently on the ASX away from the underlying companies, if someone paid $18, Peter, they'd be paying effectively buying it at a 20% premium to its underlying NTA.
Okay, we've got a chart on the screen. Quickly explain that, please.
Really important to look at what's happened to the NTA over time. And this is a chart courtesy of AFIC that shows how the Australian Foundation Investment Company, stock code AFI, how its share price has varied relative to its NTA. It's been as high as a premium of 15% and a discount as low as 10%.
So what's the main takeout, Paul?
Well, the main take for me is I would buy a listed investment company over an ETF if the listed investment company was trading at a discount, or potentially even a small premium of 2 or 3%. If it was trading at a large premium, I'd stick to the ETF because I know I'm going to get index return less a fraction.
A really good summary. That's Switzer Super TV for this week. Once again, thanks for joining us.